I have been making a move that almost nobody is paying attention to. While the financial media obsesses over artificial intelligence stocks and the Federal Reserve's next interest rate decision, I have been quietly building positions in one of the most unloved, most ignored, most undervalued sectors in the entire market. Gold miners now, I know what you are thinking. Gold miners in 2026. That sounds like something your grandfather would invest in. That sounds like a relic of a bygone era. That sounds like the opposite of exciting. And you would be right, gold miners are not exciting. They are not trendy. They are not what people talk about at cocktail parties. But that is exactly why I am interested. The best investments are almost always the ones that nobody wants. The ones that have been left for dead. The ones where expectations are so low that any improvement creates massive upside. I built my career on finding these kinds of opportunities. In 2005, I found the most unloved trade imaginable, shorting subprime mortgages when everyone thought housing could only go up. I was early, I was mocked. I was questioned by my own investors, but I was right. And being right when everyone else was wrong is how fortunes are made. I see a similar setup in gold miners today. A sector that has been abandoned by mainstream investors. A sector where valuations are at historic lows. A sector where the underlying fundamentals are actually improving while nobody is watching. And a sector that could deliver returns that dwarf what you can get from the crowded trades that everyone else is chasing. Let me explain why I am making this move. The first reason is the macro environment. We are living through a period of unprecedented fiscal and monetary experimentation. Governments around the world have taken on debt levels that would have been unthinkable a generation ago. Central banks have created trillions of dollars, euros, yen, and yuan out of thin air. The global financial system is more leveraged and more fragile than at any point in modern history. In this environment, gold serves a purpose it has served for thousands of years. It is a store of value that cannot be debased by government decree. You cannot print gold. You cannot create it with a keystroke. It exists in finite quantities. And those quantities grow only slowly as new gold is mined. When confidence in fiat currencies wavers, when people start to question whether the paper in their wallets will hold its value, they turn to gold. This is not speculation, this is history. Every period of currency debasement, from ancient Rome to Weimar Germany to modern Zimbabwe, has seen gold maintain its purchasing power while paper currencies collapsed. I am not predicting imminent currency collapse, but I am observing that the conditions that have historically led to currency problems are present today. Massive government debt, central bank balance sheets bloated with assets, political inability to control spending. These are warning signs that prudent investors should not ignore. The second reason is the supply and demand dynamics for gold itself. On the demand side, central banks around the world have been buying gold at a pace not seen in decades. China, Russia, India, Turkey, and dozens of other countries have been adding to their gold reserves. They are diversifying away from the US dollar. They are seeking assets that cannot be frozen or sanctioned. They are preparing for a world where the dollar's reserve currency status is no longer guaranteed. This central bank buying is structural, not tactical. It reflects a fundamental shift in how countries view reserve assets. After the United States froze Russian central bank reserves following the invasion of Ukraine, every country in the world took notice. They realized that dollar-denominated assets are only safe as long as you remain in America's good graces. Gold has no counterparty risk. It cannot be frozen, it cannot be sanctioned. For countries that want true reserve asset security, gold is the answer. Consumer demand for gold remains strong, particularly in Asia. India and China together account for over half of global gold jewelry demand. As these economies grow, as their middle classes expand, demand for gold grows with them. This is a demographic tailwind that will persist for decades. On the supply side, gold production has essentially plateaued. Despite high gold prices, global mine production has not increased significantly. The easy gold has been found, the remaining deposits are deeper, lower grade, and more expensive to develop. The lead time to bring a new mine into production is 10 to 15 years. There is no supply response coming that will dramatically increase production. This supply-demand imbalance is bullish for gold prices, And what is bullish for gold prices is even more bullish for gold miners because miners provide leveraged exposure to the gold price. The third reason is the specific opportunity in gold mining stocks. Gold miners are trading at valuations that are historically cheap relative to the gold price. The ratio of gold mining stocks to the gold price itself is near multi-decade lows. This means that even though gold has performed reasonably well, gold miners have dramatically underperformed. Why has this happened? Several reasons. First, gold miners have a terrible reputation for decades. They destroyed shareholder value through bad acquisitions, poor capital allocation, and cost overruns. Investors who bought gold miners expecting leverage to gold prices were disappointed again and again. This history has created deep skepticism that persists even as the industry has improved. Second, gold miners have been abandoned by generalist investors. The rise of passive investing has concentrated capital in large-cap technology stocks. The average fund manager has zero exposure to gold miners. They are not even on the radar. This lack of demand has depressed valuations. Third, ESG concerns have made some investors reluctant to own mining companies. Mining has environmental impacts that make some institutions uncomfortable. This has created another source of selling pressure that has nothing to do with the fundamental value of the businesses. But here is what the market is missing. The gold mining industry has changed dramatically over the past decade. The disastrous acquisitions that destroyed value in the early 2010s have been followed by a period of consolidation and rationalization. The surviving companies have stronger balance sheets, lower costs, and more disciplined management teams. The cowboys who chase growth at any price have been replaced by operators focused on returns on capital. Cost structures have improved significantly. The average all-in sustaining cost for gold production has declined from over $1,200 per ounce to under $1,000 for the best operators. With gold trading near $2,000 per ounce, that means margins of $1,000 per ounce or more. These are exceptional margins that are not reflected in stock prices. Capital allocation has improved. Instead of pouring every dollar into growth projects with uncertain returns, gold miners are returning capital to shareholders through dividends and buybacks. The dividend yields on major gold miners are now competitive with utilities and REITs. These are real cash returns, not promises of future growth. The free cash flow generation at current gold prices is remarkable. Major gold miners are generating free cash flow yields of 10, 12, even 15%. That means they could buy back their entire market capitalization in 7 to 10 years at current cash flow levels. That is extraordinary value by any measure. Let me give you the framework I use to evaluate gold mining investments. The first thing I look for is low-cost production. The gold mining business is brutally competitive. When gold prices fall, the high-cost producers lose money and eventually go bankrupt. The low-cost producers survive and take market share. I want to own the companies that can make money even if gold falls significantly from current levels. The best gold miners have all-in sustaining costs below $900 per ounce. At current gold prices around $2,000, that is a margin of $1,100 per ounce. Even if gold fell to $1,500, they would still be profitable. That downside protection is valuable. The second thing I look for is reserve life. Gold miners are depleting assets. Every ounce they produce is one less ounce in the ground. I want companies with long reserve lives that do not need to find or acquire new deposits, just to maintain production. A reserve life of 15 to 20 years or more provides confidence in the sustainability of the business. The third thing I look for is jurisdictional safety. Gold deposits exist all over the world, including in countries with unstable governments and uncertain rule of law. I prefer companies with operations in stable jurisdictions like Canada, Australia, and the United States. The political risk premium for operating in unstable countries is not worth it. The fourth thing I look for is balance sheet strength. Gold is volatile. Prices can fall 30 or 40% in a downturn. Companies with heavy debt loads can be forced into distressed sales or bankruptcy during these downturns. I want companies with low debt and strong liquidity that can weather any storm. The fifth thing I look for is management quality. The history of gold mining is littered with value, destroying decisions by empire-building executives. I want management teams with track records of disciplined capital allocation, shareholder-friendly policies, and operational excellence. Now let me talk about why I am focused on gold miners rather than physical gold itself. Physical gold is fine as a store of value. It provides protection against currency debasement, but it does not generate any income. It just sits there. An ounce of gold today will still be an ounce of gold in 10 years. Nothing more. Gold miners, by contrast, are operating businesses that generate cash flow. They take gold out of the ground, sell it at market prices, and keep the difference between the price and their costs. As long as their costs are below the gold price, they make money, and they can use that money to pay dividends, buy back stock, acquire new deposits, or invest in efficiency improvements. Gold miners also provide leverage to the gold price. If gold goes up 10%, a gold miner's profit margin might go up 20 or 30% because their costs are relatively fixed. This leverage works in both directions, which is why cost discipline matters so much. But for investors who are bullish on gold, miners offer a way to amplify that view. The leverage is most pronounced when gold miners are starting from depressed valuations, which is exactly where we are today. The stocks have been beaten down so much that they are not fully reflecting current gold prices, let alone higher future prices. If gold rises and valuations normalize, the returns from miners could be several times the returns from gold itself. Let me also address the risks, because no investment is without risk. The biggest risk is a significant decline in gold prices. If gold fell to $1,500 or below, gold miners would see their margins compress dramatically, stock prices would fall, some higher-cost producers might face financial distress. This is a real risk that cannot be ignored. However, I think this risk is lower than the market believes. Central bank buying provides a floor under gold prices. The supply constraints limit downside. The macro environment remains supportive. And the companies I favor have cost structures that would allow them to remain profitable, even at significantly lower gold prices. The second risk is operational problems. Mining is a difficult business. Things go wrong, mines flood, equipment breaks, labor disputes disrupt production, grade reconciliation problems reduce output. These operational risks are always present and can impact individual companies significantly. Diversification helps manage this risk. Owning a basket of gold miners rather than concentrating in a single name spreads the operational risk across multiple operations in multiple jurisdictions. The third risk is that gold miners continue to be ignored by the market. Just because something is undervalued does not mean it will be recognized. Valuations can stay depressed for extended periods. The opportunity cost of capital tied up in unloved sectors can be significant. This is a real risk, but I think the catalysts for revaluation are building as inflation persists, as government debt continues to grow, as geopolitical tensions increase. More investors will seek gold exposure. And when they do, they will discover that gold miners offer the best value. Let me talk about how I am implementing this thesis. I am building positions in a diversified portfolio of gold miners. I am focused on the large cap, low-cost producers with strong balance sheets and long reserve lives. These are the companies that will benefit most from higher gold prices while having the resilience to survive. If prices disappoint, I am also looking at royalty and streaming companies. These are companies that provide capital to mining projects in exchange for a percentage of future production or the right to buy production at fixed prices. They get gold exposure without the operational risks of actually running mines. The margins are exceptional and the cash flow is predictable. I am avoiding the junior explorers and developers. These are smaller companies that are looking for gold deposits or trying to build new mines. They are highly speculative. Most of them will fail. The risk-reward is not attractive for the level of uncertainty involved. The position sizing is meaningful but not extreme. I think gold miners should represent 10 to 15% of a diversified portfolio that is large enough to materially impact returns if the thesis plays out, but not so large that being wrong would be catastrophic. Now, let me talk about the catalysts that could drive gold miners higher. The first catalyst is higher gold prices. If gold breaks above its all-time highs and moves toward $2,500 or $3,000 per ounce, gold miners will surge. The margin expansion at those prices would be dramatic. The stocks would need to be rated to reflect the higher earnings power. The second catalyst is sector rotation. At some point, investors will rotate out of the crowded technology trades and look for alternatives. Gold miners offer value, yield, and diversification benefits that are increasingly attractive as technology valuations stretch. When this rotation happens, the flows into gold miners could be substantial. The third catalyst is M&A activity. The large gold miners need to replace their depleting reserves. Acquisitions are one way to do this. If we see a wave of M&A at premiums to current prices, it would highlight the undervaluation of the sector and pull up all stocks. The fourth catalyst is simply the passage of time. As gold miners continue to generate free cash flow, pay dividends, and buy back stock, the value will eventually be recognized. The companies cannot stay this cheap forever while returning this much cash to shareholders. Let me close with some perspective on why this opportunity exists and what it means for you as an investor. The market is not efficient. It is driven by narratives, by momentum, by the fear of missing out and the pain of being different. Right now, the narrative is AI and technology. The momentum is in the Magnificent Seven. The fear of missing out is driving everyone into the same crowded trades. Gold miners are the opposite of all that. There is no compelling narrative driving interest. The momentum has been negative for years. There is no fear of missing out because nobody is talking about them. They are completely off the radar. This is exactly the kind of environment where value is created, where patient investors can accumulate positions at depressed prices, where being willing to be different creates the opportunity for exceptional returns. I have spent my career looking for situations like this. Situations where the market is wrong, where the consensus has missed something important, where the price does not reflect the fundamental reality. Gold miners fit that description today. They are real businesses generating real cash flows. They are trading at valuations that ignore their current profitability, let alone their potential at higher gold prices. They are unloved, ignored, and undervalued. That will not last forever. At some point, the value will be recognized. When it is, the investors who positioned early will be rewarded handsomely. I am quietly moving into gold miners because I believe this is one of the best risk-adjusted opportunities in the market today. The downside is limited by cost structures and balance sheets. The upside is substantial if gold prices rise or valuations normalize. This is not a trade for the next quarter. This is a position for the next cycle. The patient accumulation of quality gold mining companies at depressed prices. The crowd is chasing AI stocks at 50 times earnings. I am buying gold miners at 5 times cash flow. Time will tell who was right, but I know which side of that bet I want to be on. The opportunity is here. The value is real. The time to act is now. Let me go deeper on the specific characteristics I look for in gold mining investments, because the details matter enormously in this sector. When I evaluate a gold miner, I start with the geology. Not all gold deposits are created equal. Some deposits have high-grade ore, meaning more gold per ton of rock processed. High-grade deposits are more profitable because you get more gold for the same amount of mining and processing work. A deposit with 10 grams per ton is dramatically more valuable than one with 1 gram per ton. The geometry of the deposit also matters. Is it near the surface where it can be mined cheaply with open pit methods? Or is it deep underground where costs are higher and operations are more complex? Surface deposits generally have lower costs and faster development timelines. The metallurgy is another critical factor. How easy is it to extract the gold from the rock? Some gold deposits are straightforward to process. Others have complex metallurgy that requires expensive and complicated processing circuits. Refractory ore, where the gold is locked in sulfide minerals, is particularly challenging and expensive to process. I spend a lot of time understanding the geology of each deposit I consider investing in. The geology determines the economics, and the economics determine whether shareholders will make money or lose it. Let me talk about the cost structure in more detail, because this is where gold miners live or die. The industry uses a metric called all-in sustaining cost, or AIC. This includes the direct mining costs, processing costs, site administration, royalties, and the sustaining capital needed to maintain production. It gives you a comprehensive view of what it costs to produce an ounce of gold. The best gold miners in the world have AIC below $800 per ounce. At gold prices around $2,000, that is a margin of $1,200 per ounce. These are exceptional businesses. The industry average AIC is around $1,000 to $1,100 per ounce. These are decent businesses at current gold prices, but more vulnerable if prices fall. The high-cost producers have AIC above $1,300 or $1,400. These companies are marginal at best. They make some money when gold is high but bleed cash when it falls. I avoid these companies because the risk-reward is unfavorable. Understanding where a company sits on the cost curve tells you how it will perform in different gold price environments. The low-cost producers make money in almost any environment. The high-cost producers need high prices just to survive. Let me also discuss reserve and resource quality, because this determines the longevity of the business. Gold miners report their reserves and resources according to strict accounting standards. Reserves are deposits that have been proven economically viable at current prices with current technology. Resources are deposits that are geologically indicated but not yet proven economic. I focus on reserves because they represent the high-confidence inventory. A company with 20 million ounces of reserves has decades of production ahead of it. A company with only 5 million ounces needs to find or acquire more gold just to maintain its business. The reserve grade is also important. Higher grade reserves generate more value because each ounce costs less to produce. I prefer companies with reserve grades above 2 grams per ton, below 1 gram per ton. The economics become challenging. Reserve replacement is a critical metric. Every ounce a gold miner produces depletes its reserves. The company needs to replace those ounces through exploration, development, or acquisition just to maintain production. Companies that consistently replace more reserves than they produce are building long-term value. Companies that are depleting without replacement are liquidating their assets. Let me now discuss the management factor, because in gold mining, management quality can mean the difference between creating and destroying shareholder value. The gold mining industry has a terrible history of value destruction through ill-timed acquisitions. Executives would buy other gold companies at the top of the gold price cycle, paying huge premiums that were never justified. When gold prices fell, they were forced to write off billions in goodwill. Shareholders lost enormous amounts of wealth. The most famous example was Barrick Gold's acquisition of Placer Dome in 2006, and the subsequent buying spree that culminated in overpaying for copper assets in 2011. Barrick destroyed tens of billions in shareholder value through these deals. Today's gold mining executives have largely learned from these mistakes. The emphasis has shifted from growth at any price to returns on capital. Management teams talk about disciplined capital allocation, free cash flow generation, and shareholder returns. Actions have matched words, with meaningful dividends and buybacks becoming common. I look for management teams with track records of disciplined decision-making. Teams that have avoided the boom-bust acquisition cycle. Teams that prioritize shareholder returns over empire building. Teams that have skin in the game through meaningful stock ownership. Let me talk about the different ways to gain gold mining exposure, because there are multiple approaches with different characteristics. The first approach is to own the large-cap gold miners directly. Companies like Newmont, Barrick, Agnico Eagle, these are the blue chips of the gold mining world. They have diversified portfolios of mines across multiple jurisdictions. They have strong balance sheets and established track records. They are the safest way to gain gold mining exposure. The advantage of large caps is stability and diversification. If one mine has problems, it is a small portion of the overall company. The disadvantage is that large caps tend to have higher average costs and less leverage to gold prices than smaller companies. The second approach is to own mid-tier gold miners, companies producing 300,000 to 1 million ounces per year. These companies often have better cost structures than the large caps, because they focus on their best assets. They have meaningful leverage to gold prices while still being large enough to manage operational risks. Mid-tiers are where I find the most attractive risk-reward in the current environment. Large enough to be stable, small enough to be nimble, and cheap enough to offer significant upside. The third approach is royalty and streaming companies. Franco-Nevada, Wheaton Precious Metals, Royal Gold. These companies provide financing to mining projects in exchange for royalty payments or the right to buy production at fixed prices. They get gold exposure without the operational headaches of actually running mines. Royalty companies have higher valuations than miners because of their superior business models, but the valuations are justified by the quality and predictability of cash flows. For investors who want gold exposure with less volatility, royalty companies are excellent options. The fourth approach is gold mining ETFs. These provide instant diversification across many gold mining companies. The GDX ETF holds large-cap gold miners. The GDXJ ETF holds junior miners. These are easy ways to gain broad sector exposure without the work of selecting individual companies. I prefer owning individual companies because I can focus on the highest quality names. But ETFs are reasonable alternatives for investors who do not want to do the detailed analysis required for individual stock selection. Let me address the question of timing because this is always the hardest part of investing. Gold miners have been cheap for years. They could stay cheap for longer. The opportunity cost of waiting for a catalyst that takes years to materialize is real. I have thought carefully about this. My conclusion is that the timing risk is acceptable given the valuation opportunity. Gold miners are generating significant free cash flow at current gold prices. They are paying dividends. They are buying back stock. Even if stock prices do not move, investors are getting meaningful returns from these cash distributions. This is different from owning a speculative asset that generates no cash flow. With gold miners, you are being paid to wait. The dividend yields are substantial. The buybacks are accretive. Time is working for you even if the market does not immediately recognize the value. Furthermore, I see catalysts building that could accelerate the revaluation. Inflation is not going away. Government debt continues to grow. Geopolitical tensions are increasing. The de-dollarization trend is accelerating. All of these factors are supportive of gold prices and gold mining stocks. I am not trying to time the exact bottom. That is impossible. What I am doing is accumulating positions at attractive valuations and letting time work in my favor. The eventual payoff should more than compensate for any waiting time. Let me also discuss portfolio construction because how you size and manage gold mining positions matters. I think gold miners should be a meaningful but not dominant position for most investors. 10 to 15% of a portfolio is appropriate. This is large enough to materially impact returns if the thesis plays out, but not so large that being wrong causes permanent damage. Within the gold mining allocation, I prefer diversification across multiple companies. No single gold miner company should be so large that an operational problem causes catastrophic losses. Owning 5 to 10 different gold mining names spreads the company's specific risk appropriately. I also believe in position sizing based on quality. The highest quality, lowest risk miners should be larger positions. The more speculative situations should be smaller. This tilts the portfolio toward the names most likely to deliver and away from the names where something could go wrong. Rebalancing is important as positions move. If one holding appreciates significantly, trimming back to target weight locks in gains and maintains diversification. If one holding underperforms while fundamentals remain intact, adding to the position at lower prices improves the cost basis. Let me close with a final thought on why this matters. We are living through a period of profound uncertainty. The global financial system is more leveraged than ever before. Government debt levels are unprecedented. Central banks have exhausted their conventional tools. The geopolitical order is shifting in ways that create new risks. In this environment, having some exposure to real assets, to things that cannot be printed or debased, makes sense. Gold has served this purpose for millennia, and gold miners provide leverage to gold with the additional benefit of cash flow generation. Most investors have zero exposure to gold miners. Their portfolios are dominated by stocks and bonds that will suffer if inflation persists or if confidence in fiat currencies wavers. They are concentrated in bets that require the current system to continue functioning as it has. I prefer to have some insurance, some exposure to assets that will perform well if the consensus is wrong about inflation, about central banks, about the stability of the financial system. Gold miners provide that insurance while also offering attractive returns if nothing dramatic happens and gold simply stays at current levels. The risk-reward is asymmetric. The downside is limited by cost structures, balance sheets, and the floor central bank buying puts under gold prices. The upside is substantial if any of the bullish catalysts materialize. This is exactly the kind of trade I look for. I have been quietly moving into gold miners because I believe this is one of the best opportunities in today's market. The sector is unloved, undervalued, and ignored. Those are exactly the conditions that precede major moves higher. The crowd is focused elsewhere. The smart money is accumulating. The value is undeniable. The catalysts are building. When gold miners finally have their moment, the investors who positioned early will be richly rewarded. I intend to be one of them. Join me. The opportunity of a decade is waiting. Now, let me share some additional thoughts on the broader implications of this investment thesis, because understanding the context helps reinforce conviction during periods of volatility. The gold mining sector represents something increasingly rare in today's markets. Genuine value. In a world where investors pay 50 times earnings for growth stocks with questionable paths to profitability, gold miners offer single-digit multiples on proven cash flows. In a world where speculation masquerades as investment, gold miners provide real assets in the ground that will eventually be converted to cash. This is old school value investing. The kind Benjamin Graham wrote about, the kind Warren Buffett practiced before he started buying technology stocks, the kind that built fortunes for generations of investors who had the patience to buy when others were selling, and the conviction to hold when the market disagreed. I have always believed that the best investments are the ones that nobody wants, the ones where you have to explain why you own them, the ones that make people question your judgment. Those are the investments where the genuine opportunity lies, because the lack of competition means prices have not been bid up to fair value. Gold miners fit that description perfectly today. Nobody wants them. Fund managers avoid them. Individual investors ignore them. The financial media never mentions them. They are the forgotten sector in a market obsessed with the latest technology fad. That will change. Markets rotate. What is unloved today becomes the hot sector of tomorrow. The capital that is piled into overvalued technology will eventually seek returns elsewhere. And when it does, gold miners will be discovered by a new generation of investors who will marvel at how cheap they were. The question is whether you want to be positioned before that rotation or scrambling to catch up after it happens. I prefer to be early. I prefer to accumulate positions when prices are depressed rather than chasing when prices are already elevated. That approach requires patience and conviction, but it is how real wealth is built. Let me also address the emotional challenge of owning gold miners, because this is a sector that tests your resolve. Gold is volatile. It can drop 10 or 15% in a matter of weeks. Gold miners are even more volatile because of their leverage to the gold price. A 15% drop in gold can easily translate into a 30% drop in mining stocks. This volatility is uncomfortable. The financial media will tell you that gold is a relic, that it pays no yield, that it has no intrinsic value. Every time gold corrects, the bears come out in force with their critiques. If you own gold miners, you will be exposed to this negativity constantly. You need to tune out the noise. You need to focus on the fundamentals. You need to remember why you own what you own. The central bank buying is real. The supply constraints are real. The fiscal pressures that support gold are real. None of those fundamentals change because of short-term price volatility or media commentary. The investors who build wealth in gold miners are the ones who can hold through the volatility, who can add to positions during corrections, rather than selling in fear, who can maintain conviction when the market is questioning their judgment. This emotional discipline is essential. I have held positions through worse drawdowns than gold miners are likely to experience. The housing short went against me for 2 years before it paid off. I learned that being early and right is much better than being late and wrong. The same principle applies here. The final point I want to make is about the asymmetry of this opportunity. In most investments, the potential upside and downside are roughly balanced. You might make 20% or lose 20%. The risk-reward is symmetric. Gold miners today offer asymmetric risk-reward. The downside is limited because valuations are already depressed, costs are low, and balance sheets are strong. Even if gold fell significantly, the best miners would survive, and their stock prices have already discounted considerable pessimism. The upside is substantial because valuations have so much room to expand. If gold rises meaningfully, margins would expand dramatically. If valuations normalize to historical averages, stocks could double from current levels. If both happened, the returns could be several multiples of the starting investment. This asymmetry is what makes gold miners so attractive. You are risking a little to make a lot. The odds are in your favor. The math works. That is why I am quietly moving into gold miners, not because they are exciting, not because they are popular, but because they offer one of the best risk-adjusted opportunities in today's market. The time for this trade is now. The value is here. The opportunity awaits those with the wisdom to see it and the courage to act on it. Do not miss it.